Hello everybody, this is Halstead and Andrew McMillan here with REH CPA. Today we want to talk about the deductible mortgage interest. What's deductible, what's not deductible, the rules surrounding it, just to give you guys a better education of, of one of the biggest deductible line items on your tax return. Andrew, can you help us, our clients, understand a little bit better that tax deduction?
Yeah, so to understand the deduction, you kind of have to understand two tax laws. So before the Tax Cut and Jobs Act, which went into effect in 2018, we had some old rules for mortgage interest that still apply today, because if you acquired your home prior to 2018, you're still under those rules.
So pre-2018 rules.
Right. So before 2018, if you had a home, you could deduct two types of mortgage interest. It would be what's considered home acquisition debt or home equity line of credit interest. So home acquisition debt is debt up to $1 million that is used to buy, build, or substantially improve your residence. And you can do it on two homes. So that would be home acquisition debt. Home equity line of credit debt, HELOC debt, you could deduct up to $100,000 of interest. Of home equity line of credit debt, you could deduct interest on up to $100,000 of principal debt. So, and it's important to make the note that you could use your home equity line of credit to buy a car or buy a boat or go on vacation. You could use that money almost for anything, and it would still qualify as mortgage interest that could be deducted on your tax.
But then that all changed in 2018 with...
Yep, so that all changed with the Tax Cut and Jobs Act. It went into effect in 2018, and if you bought a home after December 15th of 2017, that would be your line in the sand. If you bought a home after that date, then you are now under these new rules. So you can only, under the new rules, you can only deduct mortgage interest on debt up to $750,000. So it used to be $1 million, they dropped it down to $750,000. So, and you also cannot deduct home equity line of credit interest. They basically got rid of it altogether. So it's a little deceiving though, because you still can deduct home equity line of credit interest, but it has to have been used to buy, build, or substantially improve your home. You can no longer use it for any of those other things that I previously mentioned about boats or vacations or anything else. So, and it has to be less than that 700.
Now, if I have two houses, what are do each of them get the 750, or is it combined?
So it is combined. So both homes combined together have to have debt of less than $750K. So you can't have $750K on one home and another $750K on another home. That doesn't work. It has to be a combined. You have to combine them both together, and both of those principals have to be less than $750K.
Now let's say my total principal amount on two residences, or even one residence, is let's say it's $1 million. How do I deal with that?
So you don't lose the deduction altogether. It's actually, you look at it pro rata. So you take a pro rata deduction there. So you limit some of your mortgage interest by the amount that is considered over the limit. So you still get a good write-off, but you are going to be limited on the interest you can deduct.
Great. Andrew, thank you for that great explanation on home mortgage interest deduction. If you have any questions on that deduction and you'd like to talk to one of our CPAs, feel free to give us a call and we'll help you out. Thanks.